You know I got your number tonight. I'm always on your team. I got your back, alright. Taking off losses if it treats you right. I wanna put you in the spotlight. You know what you've been holding back. Heart attacks every night. Oh, you know it's not right. I'll follow you way down wherever you may go. I'll follow you way down to your teeth. Hey, what's up, guys? Welcome back to Quiet Street Studios. And today we're talking about 5 places that you can invest $5,000. So before we get into that, going through our quiet market indicator here, hasn't changed much since we last spoke about a week ago. I still have us around a 2.75. So we've made some headway this week in the market. Had about 5 days of positive growth in the S&P 500. So making a little bit of an improvement this week, but I'm still curious to see where we head. I think that there's some possibility for more downward momentum. But again, we've built up some considerable upside potential over the past several weeks. So back to the question, where to invest $5,000? You'll see all kinds of articles out there like this. I'm sure you've seen them. I don't need to mention any names, but the nature of this question is flawed in my opinion. It's not the right question. Comparing it to kind of a question like, I'm gonna work out one time at the gym, which muscle group should I work on? So that's really not the right question. A better question is, how do you invest $5,000? So we'll discuss that a little bit today. Number one, you want to have a strategic allocation plan. So what do I mean by that? When you're considering investing any amount of money, you want to consider the different types of asset classes that you're going to be allocating them. So I just put together a quick brief summary of what that may look like. Here you can see you have big caps. We're going to allocate 20% of our $5,000 to that. Small caps, 10%. IPOs, which are riskier than the 2 preceding, 5%. Growth stocks, 10%. Real estate investment trusts, 15%. Potentially, depending on your age and risk tolerance, you might want to add in some bonds and ETFs as anchors to your portfolio. So I have those included as 25 and 15% respectively. So this will vary greatly depending on your risk tolerance and your age, but this is how you should be thinking when you have a monetary surplus that you're going to be committing. And a lot of people have that coming up with things like bonus pay or tax returns and things like that. So I'm getting this question pretty frequently. So think about the map for that money. And the second thing you want to think about is the different risk profiles of the assets that you're considering investing in. So some of the things that you might consider would be things like earnings growth potential. Does the company have some type of competitive advantage that makes it a big barrier for competitors to enter that particular industry? Is their balance sheet healthy or not? And do they have a sustainable user base? And is it growing or shrinking? So balance sheet, again, there's a lot of things out there that don't have a healthy balance sheet. That doesn't mean that we're going to ignore them or we don't invest in them. We're just creating essentially a risk profile to understand how that asset may potentially behave, and we're allocating it appropriately based on that. And we may also consider building out that position differently, taking advantage of the potential movement of that position. So number 3 potentially would be having a build strategy in place. So say out of that $5,000, we have a plan to commit $1,000 to Robinhood. So most people would say, okay, I'm going to take that $1,000 and put it in Robinhood stock. I'm going to jump in right away, do a cannonball, and put it all in at once. that's where identifying the risk profile of that asset comes into play. So some of those metrics that we talked about previously, like balance sheet and things like that, aren't very stable with Robinhood. So it's also within its first year of trading. So I would consider it an IPO still, which has considerable volatility. So we would want to consider the possibility that that asset is going to drop to some extent, and we're not going to get the lowest price today that we're going to see over the next several months. So we want to take advantage of that. So it might look something like this. If we're going to invest $1,000, instead of just jumping in and doing a cannonball, we're going to kind of put our toes in slowly to the water. So at a price of $18, we might put $100 in. Being realistic, we're considering that it's very possible this might drop to $12. And that shouldn't change our sentiment about this particular security. It's just the nature of this type of security. So we would want to have some downside potential there to take advantage of that. If it doesn't pan out and you really like that security, you can always transition this type of strategy to a dollar cost averaging strategy, where you would just buy, a certain amount of money over a certain time period. So say you might extend that to $200 for 5 buys every week or every 2 weeks or something like that. In that manner, no matter where the share price heads, you'll get more for your money if it goes down, and you'll get less when it goes up. So that'll keep your share price at bay for its average. But something like this, in my experience, is much better, and it works out more often than you may think. So $16, we're going to double that investment. We'll put 200 of the 1,000 in. $14, if we reach that mark, we'll put $300 in, and then $12, if it reaches that share price, we'll put 400, which would be the bulk of our position. So accounting for that, it can help you lower your average share price and add potential for earnings to your bottom line. So that's the build strategy. And then again, I'm not saying that I don't get excited about different investments, but understanding how you allocating them instead of just what is a better question. And it's not that excitement. I don't allow it to precede how I structure risk management around those positions. So that being said, these aren't recommendations of any nature. These are just things that I am personally buying. Five risky stocks that I'm buying. One is Robinhood, 2 is Uber, 3 is Square, 4 is Squarespace, and 5 is LegalZoom. So these aren't the only things I'm buying. It's not the full story by any manner, and these are riskier positions that I have tons of different anchors in place that my portfolio is allocated appropriately based on my risk tolerance. So if all of these 5 positions went to 0, it wouldn't cause any measurable wake. But on the other side, I have enough committed to them where if they do get to where I think they have the potential to, I'll make a considerable amount of money. So that's what I'm talking about today. The book, again, is Quiet Mike Speaks. If you're interested in learning more, it's available at barnesandnoble.com and at many other outlets. So consider looking into that if you want to learn more. If you guys have any comments or questions, feel free to leave them down below, and appreciate you stopping by today and look forward to chatting again soon. Take care.